Is it a competitor card on file? Yes. But is it broader than that? Does it go against direct debit as well in this country? Yes.
No one needs just the integration with the payment gateway for usual ways, like the card and banking payment.
So suddenly we are getting a much more controllable by the end user consumer piece of functionality.
Hello, everyone. My name is Igor Tomic, and today you are seeing a new episode of the Fintech Garden. And I'm pleased to introduce David Parker, who is CEO of Polymath, and actually the man with a lot of hats, but still I would like to mention some. So he's well known as a Fintech commentator, or as someone might say, educator, and lead ambassador for the Payment Association. So David, hello, how are you today?
Thank you very much. I don't know about agitator, but I try to at least be provocative occasionally in what I suggest and ask. After all, one of the joys of being a consultant, of course, is that you can ask questions that the employed part of the audience can't ask because, you know, they're employed by big corporates. So one of the joys of being self-employed is you can at least ask that awkward question maybe to the panelist and not have to worry about whether you have a job in the morning. So fun and games, yes.
And I believe actually it might be applied even if you're working for the corporations, because compliant with everything and with the loyalty, I think still the market and industry needs experts. And experts, I might say, it's someone who raised the voice and named the things that they are for real. So maybe someone who's listening to us, they can take a note of this, because that's a good part. And it doesn't make you being self-employed to improve your side. So today, I would like to talk about from promise to performance. cVRP actually compete with the cards and direct debits because it's unique functionality, I would say, for United Kingdom market. We see other approaches in other countries or regions. We're going to discuss this topic today. So what do you think about this, David?
Okay, so let's take a step back, I think. Let's start on where we are, where we've got to. So in the bigger picture, we have open banking. We've just had the FCA put out their report from the independent expert panel. I'm honoured to say I represent the Payments Association in terms of who should facilitate the future of the open banking limited. So push that to one side. So that's the mothership, the setting the standards. We now have a new scheme coming out called cVRP. cVRP, which is aimed to provide, certainly initially, reoccurring payments, as you rightly said, cards on file, direct debit, competitor. So that's where we are. Now, there are initially two phases of this. We obviously have, at the moment, we're about to go live shortly on phase one. That's charities, utilities, sort of your own accounts. This is what's considered to be your safe type of cVRP businesses, no consumer protections, and they've announced the financials on that, which is a fixed fee. And if I have it right, I think it's 1.25p and 5.5, so that's or 1.5 and 5.5, so that's 7p plus then what your PISB is charging you. So let's say all in about 10p, 12p. That's what it's going to cost a merchant to receive or set up and receive cVRP earns. Now, obviously on phase two, they're talking about ad valorem. Where that ends up is another story, but we might assume that will end up somewhere slightly cheaper than cards at about 15 basis points with some sort of consumer protection on there. And that's all still got to be worked out and everything else. So going back to your question, will it compete with cards on file? Well, certainly they've stated an aim to eventually have about 10% of the card on file market, but it's also going to compete against direct debit. So let's put these two things individually. Why direct debits? Well, direct debits work really well, and they work really well and are really cheap. The problem is when they go wrong, because when they go wrong spectacularly in terms of taking up the call center and account management time of the companies implementing them. So a lot of companies are saying, yes, cVRP will be far more expensive than a direct debit, but the cost benefit from the X percentage that go wrong in terms of call center handling and everything else, that could be interesting. So that's the direct debit group. Then we come to card on file. It's got some real advantages over card on file. So card on file, as we all know, is you give your card details, they're tokenized, and the money comes out of your debit or credit card every month. But what you can't do is put certain controls on that, which become really interesting, which cVRP are going to have. So how about I was subscribed to one of the streaming services? Nothing wrong with that. I want to say, okay, my average package each month is £20, and I know I buy the odd movie, but in my budget, I know I can't go above £35 a month. Okay. Now, when they have my card on file, I have no control. But with cVRP, I can say the maximum you can take from me is £35. Okay, so I now know I can set a maximum budget limit. That's useful to me. The next thing I can do is say, well, my contract with you is for 12 months. So I'm only going to let you take this out for 12 months. What happens at the end of that? You can't take money. So suddenly we are getting a much more controllable by the end user consumer piece of functionality. The cost is certainly, hopefully, lower than it would be certainly at phase one for those companies. And even phase two, hopefully, it's going to work out. It is going to be designed for probably slightly higher priced goods initially, in terms of, I'm talking 35, 40 pounds a month type recurring payments. But you can imagine a supermarket with a loyalty card customized the way they could maybe take the money just before they deliver to you. There's many different one-click checkouts scenarios that could be developed. But I think the key thing is it's the controllability. You as a user can easily go onto your bank account, look at what's set up in terms of your card on files and go, oh, I don't like that one. I'm stopping that now. So it has a lot of end user controllability, a lot of end user functionality that really should hopefully reduce service costs for a lot of providers doing it. So is it a competitor card on file? Yes. But is it broader than that? Does it go against direct debit as well in this country? Yes. The one thing I'd say is that Europe, Wero have talked about launching something similar, maybe in 2027 certainly, and other markets are slowly moving into this direction. So the UK is certainly back in a lead position doing something like this, but not uniquely leading, I would say.
I'm usually kind of lazy engineer. When I'm thinking about the business approaches or the technical approaches, I'm questioning why in the first place card networks didn't implement such controls, because the assumption is that they care about their customers. What we're talking about is purely the business flow rather than the technical capabilities, because with the card, it's still possible. And we see that even 3D Secure was implemented, which putting the customer into the loop back of the specific operations. And I would like to have your view. I think it's more like a speculation or even particular discussion. We cannot know for sure. But why do you think the networks didn't come up with a kind of similar setup for the control, for the spending, the time limits, the budgeting for the specific authorization?
Certainly MasterCard and Visa. MasterCard many years ago bought a company called Orbiscom, which put a lot of controls on virtual cards. And they certainly, for many years, marketed that as MasterCard in control. More towards the business end of the market, I would admit, especially with VPNs enabling you to control what's being done and your procurement and your secretary or your office of procurement, what they could buy and everything else and where they could buy it and the MSC and everything else. So these did exist. In terms of why the schemes haven't rolled out with something as national as this, don't forget, ultimately, a card is a pull payment off your account. What we're using here on cVRP is push payments, faster payments. So it's a push. It is slightly, as a technologist, slightly different technology.
Yeah, that's true. It's different concept, and that's why it explains that in this setup, the customer has more control because you kind of authorizing the payment when it's pushed, but compared to the flow with the network, card network, no one is asking you. That's even the case with the block card. When you renew the card, even if you authorize the payment and you didn't have the enough balance, then it can settle. What happening with the hotels or car rentals, even though that you didn't have a specific balance, the card still pulling the money from your account. Good spot, good analogy. I think it will give for our viewers better understanding. And in this case, I think we can go more on the first phase. Like, what do you think the merchant will get during this first phase of adoptions, or how the ecosystem will benefit?
So phase one is what's been deemed your safe businesses, I'd call them. So no consumer protection. It's going into, your investments, savings accounts. It's going into your charities, your utility bills. So you can see, a utility bill on average is, a couple of £100 for many people. cVRP, it's the pricing is pitched at, making that, saving the money and everything else. So, all your utility bills in the UK, you could argue should become cheaper if we all adopt this because it'll cost them less to collect our money. So it is all about phase one is, and I do appreciate that they are taking a crawl, walk, run approach. Many merchants will say, but we've been crawling for the last 5 years. My answer to that is yes, but it's amazing how quickly, once a baby starts walking, how quickly until it starts running. Sometimes the crawling is a very long period, but the walk and run, or the walking can be much reduced until they start running. And I think we're in a similar position here. We've gone through a very long crawl phase. It's been at times painful. Yes, more than at times painful. But we're now getting to a point where, the crawl is moving into the walk here in terms of phase one rollout before we get to phase two run. And phase two, they've committed on stage with me, the CEO. This is by the end of this year, early next year. They will, if I'm a merchant, I would certainly be looking to build out my plans for this in 2027 and cVRP. Now, what also goes with that is the branding and best open banking solutions worldwide, whether that's Swish in Scandinavia, Ideal as was in the Netherlands, Pix in Brazil. They all have in common a strong brand. Now, when I say a brand, I'm talking acceptance mark, not trust mark, and there's a big difference. We've got to assume that they will start very quickly to pull out and go forward with an acceptance mark for cVRP so that consumers can at least recognize where to see it and what it means and recognize that, oh, I've done that before, it's not a big issue and everything else.
Awareness, basically the usage awareness and ability to trust for this payment process. And I'm thinking usually from the business perspective, okay, good, we have a new ability to charge customers. Potentially it lowers down the cost, but there is potentially a hidden cost of the implementation. So in your understanding, how painful or resource taking it would be for merchants and payment gateways? Because having the technology doesn't mean that you have it integrated in your business flow and into your payment gateway.
Yes, and that's a very fair point, which is why I said it's about starting to look for these things on product roadmaps in 2027, I would argue. The integration, if you think about it, isn't very heavy. And the reason is the funds that come into you are coming down faster payment. They're coming into your bank account. Well, you already have funds coming out of faster payment into your bank account today. So that's not going to change. Okay. So what we're really talking about is, yes, a change at your gateway section, but there's a reconciliation change at the back end, certainly, in terms of how you reconcile these payments and when they come in. The challenge would be for usage on things where dispatch of goods or goods leave the merchant's hands very quickly, because the challenge here is that whilst you do a faster payment, sometimes it can take 5-10 minutes to come in. So there's going to have to be this delay. Now, for most online merchants, that's not an issue. If you buy something online, rarely is it dispatched to you within 5 to 10 minutes. Is it an issue, though? And I was talking to one such retailer at a conference, and he says because some of their worked in the wholesale food industry, they said some of their customers pay by invoice on credit effectively. But he says when it gets to the gate, the guy checks on the computer system to make sure the customer's paid. So they don't have to pay when they order, but they have to pay before it's dispatched. He said, I could see that's not going to be too big an issue for us to use cVRP to pull the money in and just check the money's actually coming to the account before we actually, send it out the door. So they didn't see it as that big a now for others it may be, you've got to wait, the reconciliation will be slightly different. But it's not major technology integration from that point of view. It's much more, and these days with payment orchestration companies and gateway providers, once they've done it, you can see that's the way it's going to go.
That's a fair point for the acquiring process, but I'm thinking more for the customers to manage their consent and those basically transactions or setting the budgets, the limits, because in the end of the day.
Well, Igor, do you ever log on to your mobile banking app?
Do I have a logo?
Do you ever log it? Do you ever go onto your mobile banking app? And one of those tabs will today say direct debits and standing orders you've got. All it's going to have on there is direct debit, standing orders, and cVRP. So the customer just goes in it's through your online banking, whether it's on the app or the website, PC. It's just standard online banking. It's very easy. 10 years ago, very few people did online banking. It would have been a nightmare to manage. Now, most people don't even do online banking. They do app banking. It's in your app.
I'm old enough to see the reports in 2018, which were issued monthly about the number of mobile users in banking in United Kingdom. And you basically check in every month and seeing the progress, like how it grows 3% per month for adoption of the mobile application.
I still remember before there was any of this, I'm afraid. This is why I have a big white beard. Don't forget, we had many iterations before we even had the mobile banking apps we do today. It will always be a challenge day one to manage any new functionality for someone. And there are many people out there today that still have a challenge even managing their banking accounts through apps or online and still prefer to walk into a branch. That's not going to change. There are edge cases we're always going to have to deal with. But if we're talking about the majority, the core, 80-20 rule, 80% of the people, they will very quickly know that if they go in their app, they can just go tick, no, tick, yes, tick, no, that's it, move on.
That's true. So nowadays, I would say that there is no barrier from the retail banks to implement and roll it out in production. Because on one side, we have the payment gateways who should be ready for adding the alternative payment methods to collect the money through the cVRP. And then we will have the retail banking to be ready with the functionality into the mobile applications and kind of guiding the customers with the consents, all the process. So where the debit is clear. But another maybe point of comparing, we well went through the card on file. So it's basically a different role. But when we're talking about the direct debit, it was there in the United Kingdom for years. Everyone is paying for the internet provider, for the utilities with the direct debit. Why do you think, is it just extension or it's kind of another abstraction of an approach?
No. So the utility companies are particularly interested in cVRP for those who have variable income. So those that get paid weekly or see big variations in their income and therefore frequently have direct debits that get declined, because you can potentially, if you do an AISP call first, check that the funds are actually available before you actually do a cVRP pull of the funds. Unlike direct debit, where you're effectively firing a missile into the dark in the hope it hits something, with this you can actually send out a seeker, check that what you want, put up a flash, put up a light, check it's there, and then send out the missile to get to it. So it is a slightly different, with AISP checking the balances first and then cVRP actually pulling off the funds. Certainly those with more challenging financial flows, they are of great interest to the utility companies. So it's not the 80% on direct debit. Actually, no, it's the 75% on direct debit that work every time. That's perfect. The 25%, because I'm counting the 5% of the 80% there that have problems. As I said, once there are problems you phone up now, can I change my direct debit? No, sir, you've missed the window on that. You can't change it for another 2 weeks. Okay, can you change it now? No, you've got to call up in another 2 weeks to change that window. No. There's a lot of complications around direct debits and changing them and managing them. cVRP for that particular audience. Remember, it's not the 80%, it's or 75%, it's the 25% that have the greater problems. That's where it becomes interesting.
That's a good point. So basically revamping the approach to make sure that all those edge cases or messy cases that were not functioning before, they will be more visible and more traceable and more manageable.
If we take the numbers, you've got 25, I'm guessing, an 80-20 rule, and of the 80%, most work, but 5% don't. That leaves us 25% not working. If we apply the 80-20 rule to that group, it means other 25%, again, we're getting about 20% now sorted. That now leaves a 5% rump where we've got problems, but we've taken out the 20%. So in direct debits and cVRP, we've got about 95% of customers dealt with. We're just left with a 5% rump now to try and deal with. And for charities and things where, if you're donating £50 a month or whatever, or something like that, that can be a great cost savings. And also, want to make sure that so much good money goes into my investment account every month. Well, you want to make it as cheap as possible.
And let's slide about economics, because we talked about the business approach, potentially the technical and the difference in aspects of those methods. But what do you think about the economics? Because what are the liabilities? What are the trade-offs here?
Well, we covered this at the beginning when I said that, initially, phase one, there's no consumer protection. You're looking at roughly 7p a transaction plus your PISP costs. So 12p, somewhere around there, and any inward banking charges you get. But, that competes against 20 basis points plus on card on file, call it 30 basis points blended. So you can see how someone can do their own maths on that much quicker than I can in terms of where the break-even point comes. But in terms of the actual economics, we also need to consider the cost of service here in terms of when it goes wrong, customer service issues and all that type of stuff, and the controllability of the customer experience. If it's a better customer experience, then people are going to jump on it.
So definitely it adds up the value as an op cost, because less hungry clients, less issues, it costs you less. It makes perfect sense. So let's maybe then discuss the future of this approach, because it sounds like an amazing instrument. And as you initially stated, it's targeted for 10% of the card on file in the United Kingdom. But what needed to be done to achieve those numbers?
Let's look at phase two. And there is still no definitive numbers have been published yet on what it's going to be, although comments have been made about it being ad valorem. There's work being done now. Let's be honest, there is going to be some challenging conversations. Let's take an example. You are a Waitrose loyalty card holder. One of the big issues merchants have with the card schemes is those with low chargeback rates pay the cost of companies with high chargeback rates. Now, Waitrose loyalty card holders, I put my card on file, and every month I do a £250 shop. Sounds like a great opportunity for cVRP. But in the model they're talking about, the cVRP, yes, it might be cheaper than cards, but there's still going to have to be some form of consumer protection because Waitrose is part of phase 2. Now, are we going to see someone like Waitrose go, no. We should be, for our loyalty card customers, deemed a safe customer, a safe merchant, and therefore we should have the fixed fees, not the ad valorem. So now there becomes an argument on which merchants are over here in safe and which merchants are in the more risky. And I think this becomes a very interesting debate out there because obviously not all grocery stores for everyone is equally safe. Waitrose is arguing it's with my loyalty card customers. But if I'm an occasional customer, am I safe as that person? And then you go to online stores and other things. It's all different areas. So there's going to be some interesting conversations. And Richard, the CEO, said as much on stage about who sits in each camp of phase 1, which is the fixed fee versus ad valorem, and who argues to be in which areas. Because obviously, if you can argue yourself into the fixed fee, you've got a much lower cost base.
That's quite a big economic stimulus. And that, I think, the devil is in details, because on the design, it sounds really lucrative, but the devil is in details how you will get into those different categories. And that totally makes sense. Maybe anything that you would like to kind of aware our listeners and viewers about this approach and next stages?
The walking and the running are going to come quicker than you expect. It's taken a long time of crawling, but we are finally getting there. And I suspect things will start moving apace now. We now have a cVRP scheme. We have a CEO. We have a board. Things move at pace. Now, some people have questioned the overall economics of being able to run such a body. At the moment, it's being, I would say, supported, donated support effectively from big players. How long are they willing to keep funding it? Obviously, it needs to very quickly start standing on its feet. To do that, it needs the volume. How quickly can it get the volume? I've had people whisper in my ear saying it won't be around in 3 years, and other people saying, well, I think just like contactless, we could underestimate it and it could suddenly go bang. You takes your money, you pays your choice. I'm not going to say where it's going, but what I'm going to say is I think, we've seen Amazon now adopt pay from your bank or open banking payments. We are starting to see traction in the industry. The question is how fast we get to that walking and running stage and how fast between the walking and the running, I'd say. But I think merchants need to start planning for things, certainly.
Right now, living in a more fragmented world, because my feeling, at least for educated industry, like if you go back into the 10 years timeline, everything is pretty standardized. You don't have much choices. You have the banking rails, you have the cards, but with the evolution of the technology, the market becomes more fragmented. It feels like we cannot ignore the new technologies and possibilities. When we think it's kind of thin margin of the market, it kind of becomes more important. I would say even minority of those payment approaches, they might dictate the trends nowadays.
Yes and no. Let us look at a market like Brazil.
Oh, that's definitely the case.
3 years ago, PixPay didn't exist.
Yes.
The market has not become more fragmented, it's become more concentrated.
That's true.
It fragmented or it morphed into a new dominant player.
So basically new monopolies.
Other markets, like in Europe, we're seeing politically the enforcement now of the launch of Wero being very supportive. You could argue is going to get more fragmented. In other markets, we've seen domestic politics, whether in Russia or India, demand they have their own payment cards. And the international ones have basically been almost kicked out. We are seeing different markets, different things happening. So I don't want to say we're seeing a more fragmented market globally. We are seeing a plethora of alternative payments globally. But likewise, we're also seeing an increasing need for relevant local payments to a local market. And that, therefore, may be caused by fragmentation or concentration, depending on the market. But there's certainly a plethora of alternative payments that if you're a global player, you need to be considering.
That's true, because that's what we see for the, last 5-10 years. Alternative payment methods become a strong word for the merchants. No one needs just the integration with the payment gateway for usual ways, like the card and banking payment, but more alternative payment method and even stuff like stablecoin. I think that's a topic for this discussion, but that also rings the bell because it's not just the local payment methods.
But stablecoins are an interesting one because they're really Most people I talk to agree they're a wholesale B2B proposition, not a B2C proposition. So that's why I don't consider them. I still believe be relatively small in B2C. They'll fragment, yes, but the main player for them is in the B2B market, certainly.
And since we are wrapping up with the end of the episode, what question I didn't ask you today, or what you would like to share with our audience and viewers?
Oh gosh, other than the answer of everything is 42.
That's a good answer. I like it. I'll take it.
See, I can always tell the techies. It is that final thing I said, which is we've been crawling a long time on cVRP. I think the walking and running stages will move faster. I think we will see greater traction on those and engagement and things moving forward. And I think we're entering an exciting period for open banking per se, with now the facilitation of the future entity moving forward and everything else. So keep your eyes peeled. If I'm a budgeting person and merchant, I need to be looking at my 2027 plans, which I'll be starting probably in 3 or 4 months' time. And cVRP should probably be on that roadmap along with open banking in terms of what I'm doing with it.
Thank you for sharing your insights and view for this matter. And thank you everyone for looking us today till the end. Please subscribe to our channels. Please comment other episodes. We have really nice overview of different technologies and latest industry trends. And thank you, David, for joining us today. It was really fruitful and insightful discussion.
Igor, thank you very much from the Fintech Garden team for having me. It's been a real pleasure.